Hey everyone, Rob B here with Rob D, and you are listening to the Property Podcast. This week, we're going to give you a topic that, if you understand, will change your financial life forever. If you don't understand, you'll be punished forever. I promise you, the claim is true. Make sure you get a pad and pen ready. This is a big episode.
Welcome to the Property Podcast. Thank you for joining us. In case you don't know, we run a business that buys more than £100 million worth of property every year for our clients. You can find out about that at propertyhub.net/invest. And in today's episode, we'll explain why you've got to do something different, because what's worked in the past does not work anymore. So all of that coming up, and make sure you stick around because we're going to end the show in possibly the most unexpected way ever.
It's time for our news story of the week now. And this week, the news story comes courtesy of The Guardian. And a news story that we are referencing has been written by Sian Berry. If that name sounds familiar, she's from the Green Party, the co-leader, and the headline reads, "Should Labour buy the supply of housing from landlords?" And what Sian is getting at is that while she may not be a fan of landlords, if landlords want to get out, then the Labour Party should be looking at buying up those properties from landlords and putting them into use as social housing. Now, the chances of this happening are slim to none because the whole process would be a nightmare to put together. They'd probably take years to even process this through. So I do not think this will happen. But the government buying up new build property, for example, to then put out to the market as social housing could be a good idea. And I'll tell you why. The reason why I think it could be a good idea is because the government is actually buying assets. The reason why we do this is because property is an asset. The government wastes money in so many different ways, but this could be a way for them to own assets that then also provide social housing. And in the future, maybe they can recycle that stock, sell it off, they've made money. While I don't agree with what Sian is proposing, the overall concept of the government buying social housing may not be such a ludicrous idea. But hey, whenever we touch politics, people get a little bit edgy. So what do you think? Am I way off the mark here, or is there something in it? Do let us know. You can always comment via our social channels, Property Hub UK.
This is an important episode because the rules of money have changed, and I think most people haven't noticed yet, or at least haven't fully internalized yet, just how much the world has changed and how you now need to do something different. Because for a long time, it was simple. You work hard, you save cash, you maybe buy index funds, and that would get you to where you want to be. But recently, the signs have been all around us, if you know where to look, that we've entered a new era where the size of government debt determines everything. It's going to determine how much everything costs you, and it's going to determine how all your investments perform. So in this episode, we're going to tell you why this is absolutely guaranteed to happen. We'll show you the signs that it already is happening, but most importantly, we'll tell you what to do so you're not punished by what's happening, but you can actually position yourself to benefit.
Long-time listeners to the podcast will know, Rob, that I've often said that the game is an unfair game. But if you know the rules of the game, instead of being punished by it, you can take advantage of it. And that's what we'll absolutely do. But something else you can take advantage of is Rob's book, The 7 Myths About Money. One of the reasons why we're doing this episode today is in celebration of the fact that the book is now available in paperback. So you'll probably see it in your local major bookshops. If you're traveling through an airport or a train station, you'll probably see it there as well. So do make sure you take advantage of it. If you haven't already, pick up a copy and recommend it to others as well. Who doesn't want to see Rob D do well? I certainly do. We also want to see you do well. So Rob, let's get into this because this is so important. We want people to understand this because the game is rigged and you really need to understand why.
That's right. As I mentioned in the introduction, it all comes down to debt. Debt is the defining feature of the world that we live in. And it makes comparisons with the past really difficult because everyone goes back to the 70s and goes, oh, this happened, that happened. But the world was completely different because governments, corporations, individuals, everyone, but especially governments, didn't have anywhere near the amount of debt that they do now. And this is a trend that's played out over the last 50 years. The amount of debt has just been going up and up and up. And there are three major events that have driven that. There was coming off the gold standard in 1971, which is what set the stage for this and actually made it possible in the first place. Then the next big event was the financial crisis in 2008. The amount of debt absolutely exploded then. And then we had COVID in 2020. Same again, even more debt. And when you take on debt, whether it's as a government or an individual, you're effectively borrowing from the future. And there's a version of that that makes sense. It's like if you take on debt to go to university, so you can get a better paying job. You know you're going to have to pay it back with future money, but it makes sense because you're going to be earning more money as a result of making this investment. And at a government level, it's the same. For a long time, it seemed plausible. We'll borrow all this money, but we'll get so much more economic growth as a result of doing this that it'll all work out. But the problem is, Rob, that's not the reason we're borrowing anymore. And it's not even that governments have got a choice about it.
This is something that really frustrates me, Rob. When I've moaned on budget podcasts in the past, a theme for me is the lack of investments into major projects and infrastructure that could actually lift the economy, and a lack of ambition there. And one of the reasons why, not the only reason, one of the reasons why is they spend so much of the debt already on stuff they're pre-committed to. So 70% is committed to healthcare, pensions, debt interest, just paying off the existing debt. It's a huge number, huge number. So when you add that all together on the amount they already borrow with, there isn't that much left. Now, the argument could be, we'll borrow more and actually do what you intended to do and put it into stuff to invest with. But you have to trust the people who are borrowing to make the right decisions. And we don't always trust those individuals to make the right decisions because we've got a big track record of failed projects or overspends and so on. So you could say instead, well, let's tax more then. Let's bring in more that way. But in the UK, tax is at a post-war high. Tax is really, really high in the UK. And you have some simplistic views from major commentators out there who say, well, just tax the rich. But the rich just leave if tax is high. The world's very mobile these days. Rich people don't have to stay in the UK. So the simplification of just taxing more, whether it be to everyone or the rich, doesn't work because tax is already super high and the rich can just move on. Many have. There's a massive exodus to the UK, but that's for another episode. So governments are locked into running these huge deficits. They're pre-committed to using the majority of that debt for things that are already in place. And debt is increasing year on year, unfortunately, faster than the economy is growing. Rob, we're depressing people here, but it's important that they really understand this is the state of play.
Yeah, it's not a good thing, but it's important to know about. And it can actually be helpful for you. There is a good side to this, which we will get to. But the result of all this is, as you've seen, we're in a choice where governments have no choice but to keep borrowing. They have to keep borrowing money. They can't tax enough to pay for their commitments and the promises that they need to make to get elected. So they need to keep borrowing more and more. Trouble is, if you keep borrowing more and more, at some point, the people lending you the money go, hang on a minute, are you actually going to be able to pay this back? And debt as a proportion of GDP, so the amount the country has borrowed compared to what the country produces, is already scarily high. They can't let that keep going higher. Otherwise, people will either stop lending the money completely or they'll start demanding higher interest rates to reflect the risk. And of course, that means interest payments go up, which means they have to borrow more just to cover the interest payment, and the whole situation snowballs. So they don't really have a choice in what they do. They have to keep interest rates lower than the rate of inflation. When you look at the numbers, it's really quite amazing. And it's one of these things where it happens slowly, so you don't realize, and for many years, just how powerful that is. But if you work out, if you have inflation of just 4%, so inflation over the last 20 years or so has averaged about 3%, even though it's meant to be 2%. So saying that it's going to go to 4% when they need to deliberately devalue the currency, I don't think is particularly aggressive. So say inflation averages 4%, then if you borrow £100,000 and you don't pay off any of it, then after 10 years, that'll be the equivalent of £67,000. And in 20 years, it'll be the equivalent of £45,000. Like Rob said, this happens while the value of your asset is going up, while your rental income is going up, while everything else is going up. And the objection you get to this, which is not an unreasonable one at all, is, well, it's risky because you take on all this debt and that's great. But what if interest rates spike? Then you're in real trouble. And yeah, of course, having debt is more risky than not having debt at all. But as we covered earlier, interest rates just can't go up that much. I'm not saying they can't be higher than they are today. Of course they can be. You need to stress test. Your bank will stress test you anyway. But 10 or 15% interest rates, which happened in the 70s, structurally can't happen now. So that's why I think understanding all this background is so important. Because even though it all sounds quite doom and gloom, and yeah, for the world at large, it is not a good thing, it can actually make you feel much more confident in what you're doing because you understand the reasons that should work. You understand the world that this is set up to work within and how that world is inevitable. And you understand the risk that you need to control for. That is a world away from doing what most people do, which is just buying property because, property prices always go up. If you understand how and why all this works, you will be so much more likely to take action and you'll be so much more committed to sticking with it, even when things get a bit tough, as they always do. If they manage to do that, if they keep interest rates lower than inflation, then over time the debt is inflated away. So even though they owe the same number of pounds, thanks to inflation, GDP has gone up. And so therefore, as a proportion, it looks better. So they absolutely have to do that. There is no other way. And contributing to that, they can't let interest rates go up too much, because you might think, well, you've got inflation. What you do when you've got inflation is you put up interest rates. Well, they can't put up interest rates too high, because otherwise, as we've said, they've got so much debt, they'll owe more interest in all this debt, and the whole thing won't work anymore. So when people talk about the inflation of the 70s, like, oh, well, if we get inflation, it'll be like the 70s, interest rates will go all the way up and it'll be 15% again. No, interest rates can't be much higher than they are, because unlike the 70s, we've now got all this debt to deal with. And because interest rates have already gone up over the last 5 years, this is already becoming a bigger problem. In the US, debt repayments cost more than the defence budget. In the UK, it's comfortably more than the education budget. We're already spending a huge amount of money. And because every year, older, cheaper debt is being refinanced onto newer, more expensive debt, this is already becoming a bigger and bigger problem, even with interest rates where they are today.
Now, this all hinges on everyone believing in this system and, most importantly, trusting this system. But there are signs that trust is starting to be broken. Gold is surging to record highs for many reasons, but one of them is the lack of trust in this system and the ability of the US and other nations to actually handle and pay back their debt. Interestingly as well, though, world banks are following suit. Gold is now the most dominated asset held by non-US central banks, replacing US bonds. That's huge. That's not the type of thing that you read about on the front of a newspaper, but that is really big. The fact that countries are moving away to gold. Thank you, Gordon Brown, for selling the UK reserves off at record lows. But most countries have bought into gold. And again, another reason why the gold prices have pushed up. With all that said, it's important to understand that this is inevitable. It's not something that is temporary. It's not something that will go away next year. It's been around for decades and it will continue because it has to continue and everyone's incentivized for it to continue. But that is useful to know because what it tells us is the world that we will be investing in for the short, medium, and probably the long term exists with this model. And if you understand what model is in play, then you can take advantage of it. But it's also important to understand what doesn't work with this model. And we'll cover that really quickly.
So let's talk about what did work but isn't working anymore. And to do that, we need to understand what it is that investors are trying to achieve in the first place. So one of the core models from my book is that investors have three motivations at the same time, and they have to balance between these motivations. And different assets and different types of investment are geared towards one of these three motivations. So we're trying to protect ourselves. We want to make sure that we survive if we lose our job or something goes very wrong. We want to maintain our lifestyles while working less, both now and then, of course, in retirement. But we want our assets to work for us so we don't have to work as much. And that's where you may be looking at things like bonds and index funds. And then we want to improve our lives as well. We want to have a better lifestyle than we do now. And that's when we get into starting businesses, stock picking, using leverage, things that aren't just going to keep you where you are, but are going to really propel you to better things. And everyone has all three of those motivations. They just have them in different proportions. So you need to figure out how to invest to balance those three. So most people, they'd like their life to be better. They'd like to be better off than they are now. But they don't really know how to do that, and they're scared of something going wrong. So they're weighted towards protection, which is cash in your own home, and maintenance, which is your bonds and your index funds. Now, it just so happens that over the last 20 years or so, this has worked out really well. If you have just been invested in index funds and government bonds, while this process of building up all this debt and interest rates falling has been going on, that's worked out great. You could have been making a return of 10% per year or more just from holding these pretty safe, diversified investments and not really doing anything. The problem is, this has now come to an end. This has happened because interest rates have been falling and all this debt has been building up. Now, that's not going to happen anymore. Bonds are guaranteed to lose value in real terms. We've already talked about how that's part of the plan. It has to happen. So bonds are not going to perform well. And then you've got stocks. You could say, well, the US stock market in particular has been performing really well. And it has. But the problem is it's performed so well that prices are now really high. Prices are now at a level where if you go back and you look at, well, what would have happened if you'd bought in at this level in the past? If you'd bought in at this level in the past, over the next 10 years, your return would have been zero. You would have made no money because you bought in at such a high level. So what that means, Rob, is we had a situation where by investing in both of those things, you would have done really well. But now both of those things are likely to start performing far more poorly than they have done. So you could be in a situation where your bonds are losing money, your stocks, just to pluck a number out of the air, are making a return of 5% a year before inflation. But then inflation could easily be 4%. So this same type of investment that's been doing so well for the last 20 years could start doing pretty much nothing at all. That's not to say forget about your pension, plunge everything into Bitcoin, but it is saying that you need to start doing something a bit different.
So you have to make a change to have just even a comfortable life in the future. And you'll either need to earn more, that's one option, save more, you could go down that route, or take more investment risk. Invest the right way. And investing in the right way can be done in different ways. One of them you could probably guess quite quickly, but you can do it via business ownership. That is one way you can win in this system, in this world. Not for everyone appreciate, and a lot of hard work, and more businesses fail than succeed. You could go for concentrated bets, so stock picking your own stocks. Not recommended for the majority of people. Something I personally like to do, but that's because I'm a control freak and a bit of a geek. So I like to do that myself. But for the majority of people, the advice that's given out over and over again is, don't do that. So for the majority of people listening, that's probably not going to be the right avenue. Or, and probably the reason you're here listening to this in the first place, is you could take on leveraged assets. Now, we've covered on the podcast over and over again, the property magic formula being our most popular concept around this, is take advantage of leverage. But what we've done in this episode today is explain why. So it's fine if you believe it as a concept, and we've demonstrated that with the numbers and the power it holds. But this episode now has given you the economic education to understand why not only can it help you, but why you must do it. Why you have to take action, because if you don't, you're just automatically going to be punished. But if you do, you take advantage of the system because you are using debt as a tool. You are using the same techniques as the world's financial system to get yourself ahead. You buy a property, you leverage it, normally to 75%, but whatever level, you leverage that asset. That debt is paid by somebody else when you own that asset. And what's beautiful is that debt is being devalued year on year because inflation is guaranteed to happen. So you take out that debt and it's being eroded. So the asset you're buying is being increased because of inflation, and you understand now why inflation is guaranteed to happen. So inflation is going to happen. Your asset's going to be worth more. The rent will increase over time, and your debt that you are holding is devaluing as well. So everything is going in your favor. It's pulling down in one direction, which is your debt, the value there, and it's pushing up in another, the assets you own. When these two things combined come together, it makes property over the medium and long term irresistible. But only if you use debt. To our cash investors out there, and there are many of you, go back and listen to this episode again. And if it hasn't landed, go back again. If you think debt is risky, I tell you what's riskier, not using it. To your financial health. I'm not saying you need to leverage yourself up to the eyeballs. I do not own a mortgage broker. There's no self-interest here. It's to help you. It's to help you as investors. By all means, buy cash and leverage later. That's okay. But the leverage part is critical. If you are buying property cash, you may as well just put it in the bank because it's a lot easier and the returns that you'll get over the long term won't be that different. But if you leverage, the returns are wildly better because the system makes it so. If you understand what is happening, and hopefully now you do, but if you don't, go back and listen again and then buy Rob's book if it still hasn't landed. But if you understand what is happening, then you put yourself in an incredibly powerful position, a position that most people don't understand. So please do share this podcast. Help others understand what is happening. Not just that property is a good thing. Some people will buy that and some people will go along with it. But when you understand that leveraged investments are the only way to really create wealth, if you don't want to start a business or do something else that's extreme risk, then it's critical that you take advantage of it. So please, if you've converted to this way of thinking already, make sure you take advantage of it. But just as importantly, share it with others. Not everyone will want to listen to a property podcast. We love that you do. You are special people. But at least share this episode. Help people understand what is going on. If they prefer reading, then give them Rob's book. They'll understand then. But it's important that people understand that this game is an unfair game, but there is a way to win.
Okay, well, let's see if we can leave you on a little bit of a lighter note with Hub Extra. And Hub Extra is not my book, even though it is out now. But Hub Extra is Suno.com. Now, you probably won't remember the name because I'd forgotten it. But long-time listeners of this show might remember that some amount of time ago, I used Suno, which is an AI music generator, to make a rap about the Property Podcast.
I'm still only just getting over that, Rob.
Yeah, exactly. Well, just you wait, buckle up. We played it out on the show and it wasn't that great. I don't hold myself up as any kind of great rap expert, but it was a novelty. It was all right, but it wasn't that special. Things have moved on. I went back and played with it again the other day, and the leap in quality in what you can do is absolutely unbelievable. I listened to a load of the things that people have created with it, and unless you really, really know what you're listening for, you would not be able to tell that it was AI at all. The leap in such a short space of time is incredible. And to prove it, Rob, I've done it again. I've written another song.
Oh no. I love the range of this podcast, from like hardcore economics to, what is it, rap again? What have you done?
No. So this time, my prompt was, write an 80s radio rock song about the debasement of fiat currency.
Oh, okay. Of course you
so
did.
There is a link. First thing that popped into my head. So that was it. That was literally the prompt. And it wrote a song. It's called Paper Money Heart. And it's really good. We'll link to it in the show notes. Maybe producer Dan will play a bit. I don't know. But that one prompt, this is what it came out with. I think it's unbelievably good.
I think we've got to play out on it, Rob. Let's just do it. Let's listen. Thanks, everyone. See you next week. Bye-bye.